Financial statements are kind of the ultimate business scorecard, right? They're
Hmm.
precise, they're structured, they're quantitative.
Oh, absolutely. They give you this sense of control. It feels really comforting.
But what if that very feeling, that numerical certainty, is actually the biggest trap of all?
That's it exactly. People forget that financial analysis isn't just calculation. It's um, it's an interpretive art. If you treat the numbers as gospel, you're missing the entire story.
You really are.
Accounting is a language.
Yeah.
It has rules and estimates, but it's not an objective photograph of economic reality.
Absolutely. And that seduction of precision is what we're digging into today. We're moving beyond the simple technical calculation of ratios and really focusing on the crucial intellectual discipline you need for critical financial judgment.
Right.
We've pulled together what I think are the most critical warnings from our source material about the cognitive and technical pitfalls that analysts consistently fall into.
And our mission for this deep dive is pretty simple. We want to uncover the 4 key traps that undermine effective analysis. These are traps that deal with data incompleteness, flawed comparisons, cognitive biases, and timeliness.
So the goal is to make sure your financial judgments are comprehensive, current, and critically informed, not just numerically sound.
Yeah, that's the idea.
Okay, let's unpack this. Our first major pitfall is one we call the trap of incompleteness. This is basically the danger of overweighting the quantitative data, the raw numbers on the page, just because they look so thorough.
This is a classic, and it's an unavoidable structural problem with accounting itself. Financial statements are essential. I mean, don't get me wrong,
Of course.
but they're only one part of the information spectrum. Because of the rules, the very rules that define what can be measured and reported, they fundamentally omit vital, non-quantifiable factors.
And those are often the factors that determine long-term success or failure.
Yes.
So, okay, if I'm looking at a perfect income statement, what crucial elements am I functionally blind to? What's outside the scope of, say, GAAP or IFRS, the established rules of the game?
You're blind to the human and strategic elements of the business, the things that actually create future cash flow.
Okay.
For instance, there is no line item for the quality of management.
Mm.
How stable is the leadership team? Is there a robust succession plan in place?
Right.
Those factors will radically affect the business next year, but they won't show up in this year's depreciation schedule.
And what about beyond leadership? I'm thinking about the core talent. A tech company's greatest asset might be its engineering team's morale or their collective knowledge. None of that is capitalized as an asset.
Exactly. You won't find entries for employee morale, the efficacy of ongoing technological innovation, or the true strength of a company's brand and customer loyalty.
That's a huge one, brand loyalty.
Imagine a company with a perfect balance sheet, but its brand reputation is being shredded on social media. That statement gives you a zero indication of the imminent revenue disaster.
So even if a company looks structurally robust on paper, if its CEO is about to resign or a critical new regulation is about to crush its market, the numbers are, at best, a starting point.
A foundation for inquiry, not a verdict.
That's a great way to put it.
That's the key takeaway here. The apparent precision of accounting numbers provides an essential historical baseline, but it should never, ever blind the analyst to those crucial qualitative and forward-looking factors.
If you ignore them, you're basically evaluating a company's structure without assessing its survival prospects.
I think you got it.
All right, let's pivot to the second major technical trap, which our sources call the comparability conundrum. And here's where it gets really interesting, because the numbers themselves might be perfectly accurate, but they can still lead you to the wrong conclusion when you compare two different companies.
Oh, this is a massive pitfall, a huge one.
If you ignore this technical hurdle, you end up comparing apples and oranges disguised as ratios.
Totally. And our source material details 3 distinct ways this problem crops up, all of which require serious investigative work before you even touch a calculator.
Walk us through them. Where do analysts most often stumble on this?
Okay, the first source is the different classification of items. Companies have significant and often perfectly legal flexibility in how they present their operating expenses,
Meaning?
meaning 2 identical ratios can be built using fundamentally different components.
Give us that retailer example you mentioned from the source material. It was really clear.
Okay, so let's look at gross margin. Say you're comparing 2 major clothing retailers, Nordstrom and Gap.
Two big, similar companies.
Right. You'd think it's a fair comparison. But Nordstrom includes significant items like rent expense for its stores within its cost of goods sold. That's the base cost of the merchandise.
Okay.
But GAAP, on the other hand, lists rent as a separate operating expense, so it's below the gross margin line on the income statement.
Ah, so if I calculate the gross margin ratio for both companies directly, I'm measuring two totally different things, even though the ratio has the same name.
You are.
Nordstrom's gross margin is going to look artificially low compared to GAP's, even if their underlying economics were identical.
Precisely. So if an analyst just glances at Nordstrom's reported gross margin and concludes it's less efficient than GAAP, they've made a fundamentally flawed recommendation.
Based on an accountant choice, not an economic reality.
Exactly. The analyst must normalize those statements first, move the numbers around to make them comparable.
That's a serious warning for anyone relying on, those aggregated financial data services that just poll the number.
A very serious warning.
Okay, what's the second source of these comparability issues?
The second source involves conglomerates with diverse operations. Most standard industry ratios, they really rely on comparing pure play companies, businesses that focus on one sector.
Right.
But when a company operates across multiple unrelated industries, finding a suitable benchmark becomes nearly impossible.
So if I'm analyzing General Electric, which has huge divisions in aviation, healthcare, and power, and I try to compare their total return on assets to a pure-play aviation parts supplier.
The comparison is meaningless.
Yeah.
It is, because the aviation supplier might have completely different capital needs, different margin expectations, different growth potential than, say, the healthcare division.
It's a completely different business model.
It is. The same goes for a company like DuPont, which is split between chemicals and pharmaceuticals. You can't just use a single industry benchmark. You have to break the company down by segment.
So you'd have to use a hybrid benchmark.
You'd have to, yes.
Yeah.
You'd need to reflect the performance of, say, Dow Chemical for the chemical segments and maybe Merck for the pharmaceutical segments, and then blend them.
Which requires going deep into the notes to the financial statements, way past the consolidated numbers.
Way past. And finally, the third source of non-comparability. This is probably the most famous one. Different accounting practices and assumptions. Even within GAAP or IFRS, companies make different choices about estimates, and these choices directly impact their profitability and reported asset values.
Let's slow down on the depreciation example here because the implication is really critical.
Absolutely. So imagine two companies. They both own identical factories, bought on the same day for the same price.
Okay, identical situation.
Company A decides to use a 5-year useful life for depreciation. Company B, perfectly legally, chooses an 8-year useful life. Company A is spreading that expense over a shorter period.
So company A will report higher annual depreciation expense. That means lower net income and lower reported asset values on the balance sheet, right?
Correct. So company A might look worse on profitability ratios, like return on assets or return on equity.
But not because they're actually less efficient.
Not at all. It's purely because of an arbitrary accounting choice about the useful life of an asset. An analyst has to strip out these differences and recalculate the ratios on a standardized assumption before drawing any conclusions.
That's the difference between a technician and a true analyst.
It really is.
Wow. Okay, that shifts the whole focus from calculation to true investigative adjustment work. Now let's pivot from the technical pitfalls to the psychological ones, the cognitive biases that can taint even the most technically brilliant analysis.
Yes, these are the traps that reside in our own judgment process. We're moving from the numbers to the brain.
And pitfall number 3 is what our sources dub the search for a smoking gun, the Sherlock Holmes mentality.
This is such a powerful yet misleading cognitive desire. We naturally seek simple, satisfying explanations for things.
A clean narrative.
A clean narrative, yes.
Yeah.
The trap is approaching the analysis like a detective trying to find one single spectacular flaw, that one major mistake, like a massive product recall or a fraudulent manager, that explains all the company's problems.
We crave that simple story. The company failed because of one disastrous acquisition they made in 2020.
Exactly. But business reality is almost never that clean. Most challenges arise not from some spectacular flaw, but from a collection of less dramatic problems all happening at the same time. And they're much harder to spot and diagnose.
Can you give us a detailed scenario of what an analyst might miss because they're looking for that single big mistake?
Sure. Imagine an analyst is reviewing a retailer that's seen a slow, consistent margin erosion over 4 years.
Okay, a slow bleed.
Right. The analyst finds one large write-down related to a failed European expansion and fixates on it, concluding, this is it. This is the core issue.
The smoking.
the smoking gun.
Yeah.
But by focusing only on that one spectacular item, they overlook the subtle systemic issues. Small cost creep in inventory management, a slight but persistent decline in customer service scores, and an unaddressed rise in employee turnover. Each one is minor on its own.
So they satisfy their need for a simple answer, but they miss the death by 1,000 cuts. The subtle pattern of interconnected weakness.
Yes. The danger is that the analyst assigns, say, 90% of the blame to the one identifiable event and discounts the overall pattern of operational deterioration. The real threat is that systemic, nuanced web of minor issues. It's a complexity that the human brain naturally tries to simplify.
So a great analyst looks for constellations of problems, not just lone shooting stars.
That's a perfect way to put it.
That is a powerful warning against oversimplification. Okay, let's move to the fourth and final pitfall, which deals directly with time and memory, anchoring, adjustment, and timeliness. This is the historical bias.
This pitfall is so insidious because it actually relies on good data. It's about giving excessive, often unconscious weight to long-term historical trends, say 10 years of reliable ratios, and using that track record as an unbreakable anchor for your current judgment.
But we're taught to look for trends. We're naturally inclined to trust the stability of a long-term trend. Why is that trust misplaced in financial analysis?
Because financial statements are fundamentally backward-looking. They tell you where the company has been. Timely, current information, however subjective it might feel, is often far more critical than a decade of precise historical ratios.
The past is only prologue until it isn't.
Exactly.
So when you anchor to that long history and then genuinely new information arrives, what does the cognitive bias instruct the analyst to do?
It instructs them to make only small, incremental adjustments to their established view instead of recalculating the entire future trajectory from scratch.
I see.
You see this strong historical trend, say 8% annual growth for a decade, and when a new threat appears, you adjust your estimate down to maybe 7.5%. You maintain faith in the anchor, even if the new information warrants a shift all the way down to 3%.
So what kinds of current events can instantly override 10 years of trend analysis?
Any sudden, high-impact external factor. We're talking about a sudden regulatory change that eliminates a key product market, the unexpected loss of a patent, a geopolitical crisis that cuts off supply chains, or
The unveiling of a competitor's groundbreaking technology.
yes, the source mentioned the DuPont example. A historical analysis might show rock-solid, predictable performance for years.
Right. Stable and boring.
Exactly. A detailed, mathematically rigorous historical analysis of DuPont's last decade might be rendered almost instantly irrelevant by a single press release announcing a completely new technology that disrupts the entire chemical industry.
And just like that, the historical ratios are precise, but the future they describe has been obliterated by current reality.
That's gone.
Wow. So anchoring causes the analyst to fundamentally discount crucial, timely information. It leads to assessments that are precisely calculated because they're built on a decade of solid data, but fundamentally obsolete in terms of strategic business reality. The lesson is that financial analysis is a starting gun, not a finish line.
It forces you to ask, am I looking at this company today, or am I looking at the company it was 5 years ago? True analysis demands that you treat that historical anchor as merely context, and you have to be ready to throw it overboard the moment a material current event suggests the trajectory has fundamentally changed.
So what does this all mean for you, the listener? We've covered 4 critical layers of scrutiny you have to apply to financial data. First, the intellectual humility to accept that numbers are incomplete. They have to be supplemented by those non-quantifiable qualitative factors.
Then there's the technical rigor to understand that comparison is flawed. It demands normalization and deep dives into classification differences and accounting choices.
Third, the psychological awareness to resist the urge to find one simple smoking gun and instead to embrace the complexity of interconnected minor issues.
And finally, the strategic foresight to overcome historical bias and anchoring. You have to demand the swift integration of current timely information, even if it contradicts a decade of reliable data.
The overall conclusion here is that a skilled financial analyst has to combine technical proficiency with intellectual humility and a strong awareness of their own cognitive shortcomings.
Right. Financial statement analysis is an essential tool for inquiry, but the final strategic judgment requires a much wider, more forward-looking context.
So if we connect this to the bigger picture, given that financial statements are inherently backward-looking, that they often omit the most important qualitative factors, and that they can be rendered irrelevant by a single current event, This raises an important question for you, the listener. How should a business decision maker restructure their analysis process to ensure timely, forward looking strategic thinking always supersedes a detailed but potentially obsolete historical ratio analysis?
Is it about prioritizing news flow over annual reports? Or maybe integrating competitive intelligence before the numbers even land? Something to explore on your own.